We are live, I believe. First time using Restream, so we'll see how this goes. But yeah, we're live. Appreciate anyone here being a support. I think obviously, not the price action we'd like to see, but I think there's a lot of commentary and a lot of things we want to go over. Let me make sure on my channel it's actually there. Let me see. There we go. Okay, it is. Let me post it, and we can go ahead. I think there's only like one or two people here, so no big deal.
No worries.
Let's see. You guys just want to go through the shareholder letter, and then kind of talk about it, or how do you guys want to structure it?
Yeah, we could do that.
Okay.
We can do a little quick recap. I mean, let's talk about that first page. Let's open it up. We'll do a little recap of what the was, and then we'll get into some opinions.
Let me figure out how to use Restream as I do this. All right, there we go. So for reference, Trevor, I usually use StreamYard, which is like a similar recording app, but this one's a little different where you can create like scenes or something.
Okay.
So I'm just learning as I go. Okay.
You and me both.
Works pretty well. There we go. Yeah, so Q4 financial highlights. I think really what we do, we just go over this first, and then talk a little bit about, the rest of the shareholder letter here. So Q4 financial highlights, they did 2.7 billion in network volume compared to the outlook of 2.65 to 2.9, and grew 3% year over year. Revenue was 335 million compared to our outlook of 333 to 358 million, and they grew 20% year over year. Their revenue from fees less production costs was 131 million, which increased 12% year over year. Their adjusted EBITDA, 98 million, compared to the outlook of 99 to 109 million, and grew 53%. And then GAAP net income and their net income. So GAAP income was 34 million, a 10% margin, which is pretty nice. And then 79 million for their adjusted net income. But yeah, I think revenue was expected to be 350, guys. So a little bit of So a little bit of a miss on revenue, and then a beat on EPS, so a beat on income. Obviously the stock is down as we take a look, 20%. And so let's see this. Oh, perfect. Okay, smooth. Yeah, stock is down 20% as we see. But I think a lot of it is obviously in this economy. In the stock market right now, we're in sort of a bearish trend where anything is bad news, really, especially a company showing weaker guidance and being soft and weak on target. And so I think it's, of course you're going to see a 15 to 20% drawdown, in my opinion, on earnings like that. But I mean, what do you guys think so far? I know, I think Nick and I talked a little bit beforehand about macro stuff. But Trevor, I know you're bullish guy. What are your thoughts? Just to start.
Yeah, I think kind of similar to what you guys were talking about. Revenue is disappointing. They missed by what was it, about 15 million. So it's not ideal. I think management is more so focused on profitable growth rather than growth at all costs, and I like that as a investor in the stock. I think if you can go back to that first slide that we were looking at.
Yep.
One thing I want to touch on is the network volume. So as we can see, 2.7 billion, only up 3%. The headline number doesn't look very attractive. But excluding the single family rental, which is a segment that they're winding down intentionally, every other lending vertical, personal loans, auto, point of sale, saw double-digit growth. So, excluding that single family rental, which is a segment that they're trying to kind of move away from, the network volume actually grew 34%. So I think that's pretty bullish and something to definitely take into account. I mean, we saw four consecutive quarters now of GAAP profitability, which is obviously massive.
Yep.
I think our net income annualized run rate is like 134 million. They guided for, I believe it was 100 to 150 million net income for full year 26, which based off of the $81 million that we did in 2025, it's like, what do I got here? Wrote it down somewhere. I think it's like a 26 to 85% year over year growth based on their guide. So even if it comes in at the midpoint, we've got a 50% net income growth for the year.
Yep.
So I think I think there's some uncertainty in the economy right now. And I think management would rather, slow growth down a little bit, focus on profitability rather than try to take a lot more risk and then, get bit in the butt from it. So I'm not upset with earnings. Obviously, the stock price is down heavy, but you
Yep.
can't let the stock price action dictate your thoughts on what the actual fundamentals were for the quarter.
100%. What were your thoughts, Nick?
No, I agree entirely. Like, you have to look at the shareholder letter and read what Gal said. He specifically said this is intentional. So the reason why they didn't hit revenue this quarter, like everybody anticipated, and they're actually guiding for like quite a sandbagged Q1, is because it's an intentional decision. What they're doing is they're chopping lower tier credits, essentially like anything that would increase volatility or risk for the company as a whole. They're chopping it intentionally, which is reducing growth. And that goes to what Trevor was saying. It's more sustainable long-term profitability in mind. And now they're going to sort of like pursue growth through partner expansion and also product expansion. So specifically what he said, they want to eliminate a significant portion of the tail risk. There's a lot of macro uncertainty looking forward. For example, with Fed chair, we don't really know what's going to happen. We don't know what's going to happen with rates. We don't know what's going to happen with liquidity. Even though he mentioned Gal said that we're probably going to see some more comments on this in the earnings call, but he said there's no clear deterioration in the consumer at the moment. However, they're just positioning the business so that it's in a more advantageous position. So they'll be able to navigate any sort of macroeconomic tailwind or headwinds in the future. But on the bright side, I think the business is very well positioned to outperform and surprise the street now that they've made these cuts. So here's some bright lights. So Trevor mentioned a couple things that were, very good to see, but specifically talking about product. So one of their core products, right, is the AOE, which is the affiliate optimizer engine, which is essentially is the second look engine. It's the core product they offer, which says, okay, somebody ran and failed their initial credit pass and their FICO score indicated that, this isn't really a worthy candidate for a loan. Let's use Pagaya, and Pagaya is going to do a second look, right? For example, one of their partners, their core partners with Credit Karma, which is essentially just like a broker website, they increased their volume in 2025 from 2 billion to nearly 3 billion by end of year. So they went up by, I think it was like 900 million in volume total, which indicates 45% growth year over year, just from using their one core product. And they had launched a new edition of that product, which is, using their API sort of highway, their conduit, which is, what's it called here? They just called it Pagaya API version 2, onboarding products up front. They pre-built API integrations for the entire Pagaya product suite and to make essentially easier onboarding. Nonetheless, another cool bullish indicator is that they onboarded 3 new partners. So one is Achieve, the other one is GLS, which is Global Lending Services. And then they did not announce a name, but they indicated that the third partner they onboarded was a major buy now, pay later provider in North America. So I kind of looked
Firm.
No, because Affirm has their own product that kind of competes with Pagaya slightly as for a second look engine. So there's a little bit of like overlap there. Not saying that Affirm wouldn't partner with Pagaya down the road, but it's just not intuitive. I think the most likely candidate is somebody called Zip, or formerly called, I think it was called like QuadPay, and or Sezzle. So Sezzle's another one.
Oh, Sezzle, yeah.
In the buy now, pay later space. So I think one of those two is the likely candidate. And I think what's going to happen here, if management was really tactical, and if I'm just kind of thinking outside the box, perhaps they knew that this news about the revenue growth and chopping the lower credit tiers would tank the stock this morning. And maybe in a day or two, they announce who that partner is and they hopefully get a rebound. I'm not too sure. I'm just kind of thinking outside the box here. Sometimes management likes to be a little playful with how they release news, knowing that what the impact could be. Because if you release a partner like that, that is huge with a lot of upside potential. On the same day you release earnings, that's not great, especially with guidance. Not saying that their earnings are horrible. I think the underlying earnings indicate strength in a profitable business. Where a year ago, analysts said that this business model is not profitable. They never will be profitable. Now they're just raking in the cash and they're expecting Q1, GAAP net income to be like up, I think it was like 200%, 200 to 600% in Q1, which is ridiculous. So I think it's a story of two tales, right? I think they are making decisions that are better for the company in the long term. So it has short-term headwinds to growth, which is spooking investors. But I think they have a lot of positive things looking forward, especially with their partnerships. And they're just going to keep expanding partnerships and releasing new products.
100%.
Big.
Yeah, I think you guys have. Yeah, you guys are pretty much on the ball here. I think obviously they're just being cautionary. I think a company that is obviously has loans on the balance sheet and in this macro where Warsh could be appointed, and Warsh does not favor QE, so quantitative easing, and so that's a negative headwind for Pagaya, and so management just being cautious. Like Trevor said, I think instead of trying to do growth at all costs, they're just trying to grow sustainably, and keep the profit, which I prefer. I'm an earlier investor in SoFi, and so I like that management style where you sandbag. Typically, you beat by a little bit, and you continue to sandbag and just grow profitably. Um, and yeah, like you said, I think I saw in the shareholder letter too that they are starting to have more partners. Whereas I think it was, scaling their network. So 3 new partners and multiple in the onboarding queue. So again, like you said, they're just continuing to onboard new partners and strengthen their partnerships. What is it? They're at like 35 now, 37, 33, something like that.
So if they did 3 in Q4, they'd be at 34.
34.
And I know
Okay, that's
that
what I
they
thought.
had, as of Q3, they had 8 partners in the onboarding queue, which was a double up year over year from the previous 4 quarters. So, I mean, it's a very good sign of strength as well. The more partners and lenders that they get is just more and more credibility of, okay, their technology actually works. And it's, one of the most attractive things about Pagaya is it's a win-win-win for Pagaya, for the lender, and for the consumer, right? So even if say SoFi were to stop using Pagaya's technology tomorrow, all of those loans that originally were denied, they just lose that business. So there's no really downside to keeping Pagaya, because you were going to lose that business regardless. So if they have 34 lending partners now that they've onboarded, they have yet to have a lender, a partner that they've onboarded, and then that lender came on, worked with Pagaya, and then they said, okay, the technology is not for us, and they left. Every single lender that they've onboarded has stayed within their platform and using the technology.
100%. Yeah, that's a great point. And like you were saying earlier, Nick, I mean, fourth quarter incremental net income margin of 100% year over year, fee revenue less production cost growth, and a record of 60% of cash flow from operations as a percent. So again, they're really just focusing on profitability. Do you guys want to go? I don't think we want to read the whole shareholder letter.
Yeah, you scroll down just a little bit though. The president and co-founder, scroll down just a tad bit. Yeah, right there. So under new partners, the bottom line, last line. Read that.
So, okay, got it. The under new partnerships of these, along with other ongoing enhancements, help to efficiently drive 3 recent new partner launches, achieve GLS Global Lending Services, and a major buy now pay later provider, like you were saying. Got it, in North America. Multiple additional partners, including banks, are currently being onboarded.
Yeah.
These are expected to go live within the next few quarters. Yeah, that's awesome.
Yeah,
that's awesome.
I think that's the bullish indicator right there. So Q1, I think, is going to be a rough quarter. But they're really well positioned to blow it out of the water if they start expanding other product lines and onboarding new clients. And there's a lot of growth. So it really depends on the macro environment. Like what's going to happen? Like what are these platforms going to offer to their clients? Are we going to see an uptick in loan requests? Like it all depends. I think there's some good indicators out there. Like it looks like the demand for FICO scores is going through the roof right now, at least as per FICO. So we'll have to wait and see. I mean, they're intentionally chopping lower credit tiers. So, I mean, it positions the business in a better spot long-term, more secure place to navigate volatility. However, it hits the top line. So now they're going to need to double down on partnerships. And I think that's real.
100%. Yeah, this is the CFO here. I'm just reading through to see if there's anything here that calls out. Obviously, you just kind of talk about the typical GAAP net income. Which is interesting because in In fiscal, it says they did 29 million in net income. I don't know. I must be wrong. I don't know why fiscal showing that, but I mean, 10% net income margin is awesome because I think last quarter was what 6.5%,
Something like that.
So I mean, almost doubling up your net income margin in one quarter. I mean, I love it.
Yep.
Growing profitable like that, especially when, like you said, they were unprofitable 4 quarters ago.
Yep.
So
yeah, auto and POS, a point of sale, is going to be two huge markets for them to expand into. And I'm sure we're going to hear a little bit about it on the earnings call. Last earnings call, Gal talked about that as the opportunity for them. So we'll have to wait and see. And who knows what happens with like student loan refinancing as well. I mean, just listening to what Noto was saying recently on his interview with Tanner and Tevis, that was interesting. So demand for more personal loans could increase, which that's the native business for Pagaya. So we'll have to wait and see. I mean, there's so much uncertainty. Like they're sandbagging appropriately, in my opinion, and they're positioning the business for long-term growth.
Yeah. Well, even if they were to come in and give a great guide during this uncertain market, like they would almost be setting themselves up for failure. Like they would have to come in and execute to the best of their abilities in order to just meet that guide. So I'm perfectly fine with them saying, next quarter might be a little rough. Like, it's kind of uncertain. We can't really give, exact numbers of where we think we're going to be, and then come in and just blow those numbers out of the water and take that short-term hit for that long-term gain. So, I don't really have a problem with it. Obviously the stock price is going to get hit in the short term, but that just represents a better buying opportunity for those who believe in the long-term thesis like we do.
Yeah, 100%.
Agreed.
Yeah, you can see here fee revenue less production costs hit a wall here essentially. I mean, slowly ticking up and then down to 14 million. And then staying with the adjusted EBITDA growth, or I guess it's percentage of growth, not million. Because I was like, wait a second, 14 million, that doesn't make sense.
No, that's.
I think it's growth, right?
Yeah, it's growth.
Yeah. Just showing their operating leverage here. I think there's slides.
Even at the same time, their core operating expenses declined 18% year over year to, I think, 47 million this quarter, which was 34% of FRLPC versus 49% in the year prior. So, they're still growing, and operating expenses as a whole are still declining, which is, lovely.
That's the operational leverage, baby.
Let's go.
They're showing it. They're showing it. Well, they grew, to take it back, they grew what, 20%, 21% this quarter? Year over year, essentially?
For revenue?
For revenue, yeah. 20%, I think, right?
26%.
26%, okay.
Yeah. And then net income was, what, negative 400 and something million for full year 2024. Now it's 81 million in the positive. So,
yeah, that's crazy.
It's hard to be picky with, not everything's going to be perfect, right? Sure, revenue growth wasn't as fast as we wanted it to be, but they went from burning cash every quarter to now making profit, and it looks like it's sustained profitability growth as well. 4 quarters.
And like you said, like, I mean, we're in a period where I think regardless, unless they came in and just absolutely annihilated earnings, I still think the stock goes down at least 10%.
Yeah.
So obviously a weaker guidance is going to have a drop, but
I'm just looking at that Q1 guide, guys, and I think they're going to blow Q1 out of the water. I mean, they're onboarding new partners rapidly, and they just added 3 new partners, and there's no way they're guiding there's no way they're accurately factoring how much volume they're going to do from those partners, and they're just mentioning how they're onboarding. Was it 3 new banks as well?
Yep. So I think it was. I don't know if they gave a number of the number of banks, but they said a few regional banks. Or a couple, I don't know the exact term they used.
I have my gut feeling says the volume they're going to do, that network volume for Q1, they're guiding a 7% decrease. So 2.5 billion to 2.7 billion in Q1. I think they're going to blow Q1 out of the water in volume. They have to. Like
I mean, even revenue, like you said, it's like a quarterly decline, around 3%. And then her gap net income is definitely quarterly decline there.
Yeah, I think what's going to end up happening is that they've set, like, it's going to be interesting to see what management has to say, but I think they've set themselves up to really outperform in Q1, and there's going to be a potential massive beat on the table for Q1 2026. Not massive, maybe just outperform that network volume guidance. And I think the strategy here is just increasing product use and the quantity of partners.
Yeah.
Well, go ahead, Trevor.
As of, I think it was, what was this? February 6th, they had already announced like $2.9 billion in institutional funding capacity as of January 1st. So like literally a month and 6 days. They've got like 4 or 5 new deals for forward flow agreements and ABS deals. A few, like I think 2 of them were revolving. So like they're onboarding like crazy. They're getting deals like it's nobody's business, and then they come in with a weak guide, and people think that this is actually, what's going to happen. I fully agree with Nick. I think they're sandbagging. The market's a little uncertain right now, and they would rather sandbag and then come in and just blow numbers out of the water rather than guide super high. Maybe the stock price goes up after earnings and then come in with either in line or disappoint next quarter.
I'm honestly curious to see if their guide, if it includes, how many interest rates cuts or if any at all. I listened to SoFi's earnings call, and they are guiding with 2 interest rate cuts in mind.
Yeah.
So I'm curious to see if Pagaya is guiding for 0 here. Maybe that's why we're seeing more of a conservative take. Hopefully they ask him on the earnings call. I feel like that'd be a question analysts should ask.
Somebody will.
But yeah, if I look at like maybe interest, I guess it's gonna be interest rates. So yeah, changes market interest rates. Let's see anything else. Including but not limited to rising interest rates, inflation. Okay. Yeah, so basically, like you said, they're just talking about cautionary. These forward-looking statements generally identified by the words anticipate, believe, continue. Okay, I just think that's kind of funny. Yeah, I'm honestly, I'm hoping that, or I'm assuming with the guidance they gave that they're just assuming 0 interest rate cuts, which is healthy. I think that's safe, especially with Warsh as the Fed chair. Yeah. Although I still think Trump's not stupid enough to hire anyone that's not going to cut, but on the chance that he doesn't. So someone in the comment section put, I don't know, can I show comments like I can StreamYard? Let's see here. I don't know if I can, but someone asked, does Pagaya have a history of soft guidance and big beats? I'll ask YouTube more because you guys are more my quants. Is there any? Do you guys know if they have?
I think they're just establishing a record now. Frankly, just breaking the GAAP profitability. The next couple of quarters will be telling. Right now, it's unpredictable because the company was posturing themselves to break into GAAP profitability consistently. Now they've done it for 4 quarters. We're gonna have to wait and see. I think this quarter coming up is going to be really telling. Did they intentionally sandbag to now sort of set themselves up to beat and raise? We'll have to wait and see. I'm not too sure. No. Something I did want to mention though, guys, is something to pay attention to on the call, because in the report, I just scanned the report again. There's no mention of it. However, the company is really positioning themselves towards more forward flow agreements instead of ABS. So traditionally, ABS is like securing that asset-backed securities. Essentially, they would pack the loans and they would sell them, and they would kind of negotiate with whatever institutional lenders after the fact, which isn't advantageous for Pagaya long term. What is more advantageous for Pagaya is forward flow agreements, FFs, which are pre-negotiated capital packages. So set dollars and set pricings, so that Pagaya already knows how much money they're going to be able to get out of these agreements with that specific allocated capital before issuing a loan or originating loan. So that is more advantageous for Pagaya long term. At one point of time, 100%. I think it was in Q1 2024. 100%.
It was a year ago.
Yeah.
It was Q3 2024. They were 100% ABS, and as of Q3 of 2025, so last quarter, they were 60-40, and the goal is to be around that 50-50 mark. And something that I'd like to add on top of that, Nick, is for the forward flow agreements, they don't have to hold any of the actual loans that they originate on their balance sheet. So in terms of the ABS deals, they have to retain like roughly a 5% of the loans they originate on their balance sheet for anywhere from a couple of weeks to a few months. For the forward flow agreements, they don't have to retain any of that risk. So in terms of the like total overall amount of loans that they originated as of Q3, I believe their like overall risk retained percentage was like 2 to 2.5% of the amount of loans that they originated, which is better than that tells you that the forward flow agreements are becoming more and more like a bigger percentage of the amount of loans that they're doing, the amount of deals that they're doing, and it's bringing down the amount of risk that they take, which is obviously a good thing.
Yeah. So to kind of simplify what Trevor just said, through utilizing the ABS, Pagaya was obligated to retain up to 5% of all the loans that they issue, right? So their risk profile, let's just say, is 5% of all the business they do. Just to simplify this, put it in really simple terms. Utilizing forward flow agreements and ABS and bringing that up to a 50-50 split, essentially what you do is, because with the forward flow agreements, you don't retain any risk. Pagaya, it's more advantageous for Pagaya. So essentially what they do, by having 50-50 split with all their business they do, half FF, half ABS, they reduce their risk by 50%, flat across the board. So virtually it goes to about 2.5% retention of all risk, which is very good for the business long term. So it'll be interesting to see what management says on the call. I guarantee you an analyst will ask about that.
Yeah, 100%. And speaking of call, I think, guys, it's live.
Okay, let's listen.
Let me know. Can you guys hear this?
2026.
Yep.
Our actual results
Is it quiet or is
differ
it good volume?
materially from those contemplated by those forward-looking
Nice, fine.
statements.
Yeah.
Cool.
Factors that could cause these results to differ materially from our expectations include, but are not limited to, those risks described in today's press release and our filings with the U.S. Securities and Exchange Commission. We undertake no obligation to update any forward-looking statements as a result of new information or future events. Please refer to the documents we file from time to time with the SEC, including our 10-K, 10-Q, and other reports for a more detailed discussion of these factors. Additionally, non-GAAP financial measures, including adjusted EBITDA margin, adjusted net income, fee revenue less production costs, or FRLPC percentage of network volume, and core operating expenses will be discussed on the call. Reconciliations to the most directly comparable GAAP financial measures are available to the extent available without unreasonable efforts in our earnings release and other materials, which are posted on our investor relations website. We encourage you to review the shareholder letter, which was furnished with the SEC on Form 8-K today, for detailed commentary on our business and performance, in conjunction with the accompanying earnings supplement and press release. With that, let me turn the call over to Gal.
Thank you and welcome, everyone. 2025 was a hallmark of a year. In Q4, we achieved $34 million of GAAP net income and $80 million in operating cash flow. In the beginning of 2024, we set the goal to become GAAP net income and cash flow positive, which we continue to accelerate in the fourth quarter this year. For the full year, we achieved revenues of $1.3 billion, up 26% year over year, adjusted EBITDA of $371 million, up 76% year over year, and GAAP net income of $81 million, up $483 million versus 2024, with an EPS of $0.93. More importantly, these results and achievements were the outcome of growing and diversifying our business across verticals, further expansion into first look and second look loans, and optimizing our unit economics and balance sheet. Before discussing our result and outlook, it is important to recall that 2025 was a year of discipline for Pagaya. We fine-tuned the foundations of our business and approach towards risk management and underwriting. In turn, this drives further consistency for our investors as we continue to serve our lending partner needs. All of that while building an enterprise focused on sustainable through-the-cycle growth. This discipline drove us to proactively take action later in the fourth quarter in face of persistent consumer uncertainty and trends. While our data does not indicate consumer deterioration, we have the privilege of being able to pivot our production to focus on prudence and discipline. As such, credit performance across asset classes remain in line with our expectations. However, we pulled back our exposure to higher risk, albeit profitable, credit deals, which have potential for higher relative losses in a downside scenario. As we mature as a company, we are shifting more and more of our focus to achieve the best long-term outcomes for our stakeholders and to avoid any downside that could arise from potential tail risks. We have built a business that is highly scalable with key inflection points in our operating and capital structure that results in standalone operating efficiencies. We have a robust list of onboarding partners and a healthy funding position. As important, with our data moat, technological leadership, and commercial momentum, we are positioned to continue to take share in this vast market, a market that Pagaya creates and one that Pagaya leads, and is increasingly profitable manner. Let me now talk about the long-term fundamentals of our business. It is clear that we have momentum and are executing on all aspects of our business. As we have talked about throughout 2025, future growth will continue to come from the combination of recently onboarded partners and deepening our existing relationships. Our pipeline remains robust, a testament to our product suite becoming industry standard. In the latest quarter and the months that followed, we onboarded Achieve, GLS, and a leading fast-growing buy now, pay later provider in North America. And we expect to announce additional partner launches in the coming quarters. GLS, or Global Lending Services, is a leading auto finance provider that offers financial solutions to almost 20,000 franchises and independent dealerships nationwide. As I look ahead, I'm excited about more consumer lenders joining the Pagaya network, further highlighting the potential and value added of our enterprise platform. For our existing partners, we continue to innovate, meeting our partners where they are to drive higher partner usage, satisfaction, and engagement. For instance, Lending Club recently adopted our marketing affiliate offering and became a multi-product partner for us. We expect to end the first quarter with multiple large personal loan partners fully onboarded into our pre-screen offering. Our earning power and cash flow generation will become more robust as partners continue maturing into multi-product relationships. At the same time, we continue to institutionalize and diversifying our business through long-term agreements with fee and application flow commitments, creating additional partner alignment and business stabilization. This quarter, we entered into long-term agreements with two of our largest partners in auto and personal loans. While we work to continue growing our application volume from new and existing partners, our decision to reduce our exposure is firmly grounded in portfolio optimization rather than growing just for the sake of growth. In fact, we are comfortable having a lower conversion rate when it is appropriate to reduce the likelihood of adverse outcome. As a maturing business, a core pillar of our culture is to deliberately balance long-term growth and profitability against short-term metrics. Our focus on top of funnel growth and expansion is designed for the future as we prioritize building an enterprise platform for the long term. As a B2B2C enabler, our partner depends on Pagaya to manage the business for long-term strength and stability, and they appreciate our ability and willingness to make such proactive risk-based decisions. Turning to funding, we continue to leverage favorable market dynamics to create longer-term committed capital that enhance our capacity while reducing exposure to funding volatility. This year, and in the months that followed, we made strides in diversifying our funding sources with forward flow arrangements across all three core asset classes: personal loan, auto loans, and point of sale. Building on this momentum, we further enhanced our funding stability with the expansion into revolving ABSs across point of sale and personal loan, creating almost $3 billion of revolving capacity. As we enter 2026, our guidance and business plan are driven first and foremost by this disciplined risk framework that we have developed over the years. Our accomplishment in 2024 and 2025 set us up for efficient and durable growth. We stabilized the business as we scaled, we optimized our operating costs and balance sheet, and diversified our sources of revenues and funding. Going forward, we are in the right place for balanced, efficient growth. In 2026, investors should expect more measured volume, thus revenue growth, as we prioritize reducing credit exposure over market share gains at the moment. Our strategy reflects a business that is in control of its long-term growth trajectory while deploying measured risk. With our 10-year anniversary approaching, we believe this strategy reflects a company that is building an enduring platform that maximizes value creation over time. We are building a B2B2C platform that will be cornerstone of the U.S. financial ecosystem that should be embedded within every U.S. consumer lender. Leveraging intelligent AI quant decisioning as its core, our platform will operate wherever our partners are through the cycle while powering products that meet the needs of our customers. The first decade proved our model and secured our place in the market. The next decade is about scaling that foundation with greater ambition, durability, and impact.
Thank you, Gal. As we wrap up the year with our fourth consecutive quarter of GAAP net income profitability and look ahead, our growth strategy is clear. Continue to build a sustainable and profitable business that is increasingly embedded in the U.S. financial ecosystem. Pagaya's growth continues to be driven by institutional-grade scaling of existing partner relationships as well as new partner additions. In fact, we just added 3 new partners to our platform: Achieve, GLS or Global Lending Services, and a leading fast-growth buy now, pay later provider in North America. Our onboarding process is becoming industrial-grade, minimizing partner resource requirements. All new partners have a pre-built API integration for the entire Pagaya product suite. Pre-built product APIs, along with an 18-month joint roadmap, will enable accelerated scaling. We also established long-term agreements with all of them that encompass volumes, fees, and all other protections. Our onboarding pipeline remains the busiest in Pagaya's history, with demand and traction from leading lenders in the country across banks, fintechs, and other lenders. In fact, a lot of these leading lenders are proactively engaging with us on all products, which is a testament to Pagaya's relevance and strong product-driven value proposition. We are planning to announce some new names in the coming quarters. With our existing partners, we've been consistently delivering and diversifying across products, including the direct marketing engine, the affiliate optimizer engine, and dual look. This diversification provides Pagaya with new volume beyond decline monetization, increased value and stickiness with existing lending partners, and most importantly, provides future growth for Pagaya without expanding our own risk appetite. Existing partners continue to actively adopt our products. In fact, our largest existing partners signed definitive term sheets and adopted the direct marketing engine after a series of tests and are now scaling with us across direct mail and email pre-screen campaigns. Within our affiliate optimizer engine, we recently onboarded Lending Club onto Credit Karma, where they will be presenting personal loan offers to consumers in partnership with Pagaya. Additionally, we are currently expanding our affiliate optimizer engine to include Experian's Activate platform with the launch of our first partner and several more in the onboarding queue. Lastly, we signed several long-term agreements with leading partners to establish commitments across application flow size, quality, and controls to provide further visibility through the cycle. Turning to funding, we continue to diversify from pre-funded ABS funding structure to include more committed capital structures that reduces our exposure to funding volatility. In the last few months, we have expanded our forward flow agreements into all three core asset classes, including inaugural agreements with Castle Lake and Soundpoint in auto and point of sale, respectively. This broadens our Castle Lake agreement into both personal loans and auto. We continue to innovate across our various ABS shelves. We introduced revolving structures, first in POS, and then in personal loans. We inked our second POS ABS deal and our inaugural paid revolving ABS with 26 North, which gives us a more diverse set of financing options and more visibility, hence greater consistency in our funding construct in the face of potential capital market cyclicality. I'd like to reflect broadly on the capital markets environment, which remains very supportive for Pagaya. We see continued strong demand from across insurance funds, along with traditional asset managers, while we are witnessing a higher level of rationality than we saw in 2025 from private credit. Overall, we would view the current environment as more of a steady state with healthy demand and execution, particularly for quality assets. Turning to credit performance, we remain disciplined in our underwriting with our core focus centered around gaining access to more high-quality flow from existing and new partners. We continue to leverage our unique ability to assess risk in real time, based on the data from over 30 lenders across three asset classes with agile decision-making. We continue to prioritize prudent risk management. While credit risk performance of our portfolio remains in line with expectations, we took proactive steps late in the year to reduce exposure to select higher volatility segments. These actions had a direct impact on our network volumes, revenues, and profit in the fourth quarter. Our decision was primarily driven by the changes in risk appetite that we observed across multiple lending partners of ours in light of market uncertainty. As we discussed in our outlook, the impact of these actions will restrain growth to a measured degree in the first quarter. We expect a ramp in growth through the year due to several factors that we will discuss, including the onboarding of new partners and continued penetration into existing relationships. Before I hand the call to EP for a detailed review of our financial performance and outlook, I'd like to reflect on the successes we've had across the business this past year. In summary, 2025 was a year of innovation, optimization, and profitability across all aspects of the business, laying the groundwork for growth in 2026 and the years beyond.
Thanks, Sanjeev. I will start with the big picture. In 2025, we achieved several important milestones that position Pagaya up for sustainable, profitable growth. Over the last few years, we have been deliberately reshaping this company, strengthening the foundation, tightening the operating model, improving the capital structure, and most importantly, building a much more resilient, scalable, and differentiated technology platform in consumer lending. And this past year, we made sustained investment in our data and risk infrastructure, combined with intentional decisions around risk management, balance sheet optimization, and how we grow. The cumulative result of all that work became evident in the financials as we're exiting 2025 with 4 consecutive quarters of GAAP profitability. As it relates to our 2026 growth outlook, it reflects our long-term objective to grow the platform while remaining disciplined and adaptive in how we manage risk, and even more so in an uncertain environment. We actively manage the business as a portfolio of products, partners, and risk bands, adjusting exposure as conditions evolve. When uncertainty increases, the appropriate response is to reduce exposure to higher risk segments. When conditions improve, we will reassess and reallocate accordingly. We remain focused on growth from increased product usage, penetration, and new partners. Let me walk through the numbers. For the full year 2025, we delivered $1.3 billion of revenue, up 26% year-over-year, $512 million of FRLPC, also up 26%, $371 million of adjusted EBITDA, up 76%, and $81 million of GAAP net income, representing a $483 million improvement versus last year. This reflects meaningful progress in profitability and operating leverage showing up at scale. For the fourth quarter specifically, revenue was $335 million, FRLPC was $131 million, and adjusted EBITDA was $98 million, representing a 29% margin. We reported GAAP net income of $34 million compared to a loss of $238 million a year ago. FRLPC as a percentage of network volume was 4.9%, demonstrating strong monetization while remaining disciplined on risk. Turning to network volume, we reported $2.7 billion for the fourth quarter, up 3% year-over-year. Personal loan, auto, and POS volume combined grew at a double-digit rate and was partially offset by zero SFR volume in the quarter. Personal loans remain our largest vertical at approximately 65% of total year. Auto and POS represented 19% and 16% of quarterly network volume, respectively. For the full year, network volume was $10.5 billion, up 9%. Excluding SFR, volume growth was substantially higher. Late in the quarter, we proactively tightened production in certain areas that remain profitable but could exhibit higher variability of credit outcomes and may be the first to show deterioration in a downside scenario. This was a dynamic reallocation within the portfolio away from higher risk segments with a plan to be redeployed in volume from new application flow and new products, and therefore more balanced risk. Given our visibility into new partner onboarding, new partner and product monetization, and the operating leverage in the business, we are well positioned to make these adjustments. The decision reduced fourth quarter volume by approximately $100 to $150 million without impacting the quarter's profitability targets. When risk moves and persists, we will adjust. We will not stretch. We are dynamic, we recalibrate, and continue compounding returns. Fourth quarter total revenue and other income was $335 million, up 20% year-over-year. Fee revenue grew 16% to $321 million and made up 96% of total revenue. Interest and investment income grew to $14 million. Importantly, revenue growth continued to outpace volume growth, underscoring two key trends: improved monetization and higher revenue and profit per unit of volume and risk. Full year revenue grew 26%, and interest and investment income reached approximately $40 million. FRLPC in the fourth quarter was $131 million, up 12% year-over-year, again meaningfully outpacing volume growth. FRLPC margin expanded to 4.9%, driven primarily by partner and funding mix. For the full year, FRLPC totaled $512 million, also 4.9% of network volume, up 70 basis points from 2024. I want to spend a moment on a subset of fee revenue, fees from capital markets execution. This is an area where we have progressed in a very intentional way. These fees were a negative $6 million for the quarter and a negative $21 million for the year, reflecting the pricing agreements with our forward flow partners and the risk-adjusted pricing of our ABS transactions. Specifically on ABS, negative fees reflect additional cash contribution we put in our securitization structures, in addition to our purchase of securities reflected in our investments in loans and securities. This cash contribution is accounted for as an upfront reduction in fee revenues and provide additional support against potential future credit losses. While this does not change the underlying credit performance of the asset, it reduces downside exposure and earnings volatility associated with the certificate investments we hold on our balance sheet. Most importantly, though, it also creates a clear and a tighter risk boundary for our investors. To put this into context, for every $1 billion of ABS funding, we are required to contribute a minimum of approximately $50 million of capital, i.e. 5%, in line with risk retention rules. Illustratively, a 100 basis points discount in ABS pricing translates into roughly $10 million of lower upfront fees, but also implies $10 million less in future impairments, or up to $10 million more income, all else being equal. Now let's talk about what we view as another differentiated feature of the business, our operating leverage. Adjusted EBITDA in the fourth quarter was $98 million, up 53% year over year, with a 29% margin. Core operating expenses declined to 36% of FRLPC, a 13-point improvement year over year. Incremental EBITDA margin exceeded 100%, meaning nearly every incremental dollar of FRLPC flowed through to EBITDA. The modest miss versus guidance was driven by the late quarter production adjustment. For the full year, adjusted EBITDA was $371 million, up 76%, and margin expanded to 28.5%, up 800 basis points. Turning to GAAP net income, we reported a record $34 million, our fourth consecutive quarter of profitability, compared to a net loss of $238 million a year ago. Fourth quarter GAAP net income included the positive impact of approximately $9 million from the extinguishment of corporate notes and a non-recurring tax-related benefit. For the full year, GAAP net income was $81 million compared to a $401 million loss in 2024. This largely reflects higher fee revenue alongside lower operating expenses, interest expense, and impairments, resulting in a 10% margin in the fourth quarter compared to a 6% last quarter and a negative 85% a year ago. Credit-related fair value adjustments were $107 million for the year. Adjusted net income was $275 million. Diving into credit performance, results across personal loan, auto, and point of sale remain in line with expectations and within our risk tolerance. Demand for our assets remains strong, as evidenced by new forward flow agreements, our first auto certificate sale since 2021, and the demand that we're seeing in the first few weeks of the year. 2025 vintages represent a more normalized production compared to 2024, particularly given the lower cost of funding from investors relative to prior years. As it relates to new production, rating agencies also validated that cumulative net losses are expected to be lower relative to prior production after reflecting our recent risk actions. Let's go to the specifics. Personal loan CNLs for the second half of 2024 through the first half of 2025 vintages are running 30 to 40% better than 2021 peak levels. Auto CNLs are running 50 to 70% better than 2022 vintages. While auto 60-plus delinquencies are higher than 24 following the year's pullback and broadly in line with 2023 levels, recoveries and roll rates are better than both 2023 and 2024, pointing to a normalized level of expected losses. For point of sale, credit trends remain stable and in line with expectations. As I mentioned earlier, realized credit performance remains in line with expectations, and our late quarter actions reflect increased uncertainty rather than observed deterioration. When uncertainty increases, even if losses have not materialized, the platform is designed to reduce exposure to the tails of the distribution. When conditions improve, we will adjust again. Funding remains robust. In the fourth quarter, we issued $2.9 billion in our ABS program across 7 transactions. Last week, we closed an $800 million ABS deal that was oversubscribed even after upsizing from an initial size of $600 million. With the recent announcement of our inaugural POS forward flow with Sound Point Capital, we now have forward flow agreements across all 3 asset classes. We also closed our first $350 million revolving personal loan ABS with 26 North, and combined with our 2 point-of-sale ABS revolvers, we now have about $3 billion of revolving capacity from those 3 transactions. Turning to the balance sheet, asset quality and mix have improved materially over the past 24 months, providing increased liquidity and flexibility. We ended the quarter with approximately $288 million in cash and cash equivalents, up $62 million from a year ago, and $945 million in investments, loans, and securities. As we have stated over the past year, we're leveraging our improved liquidity to make opportunistic investments to lower our cost of funding and increase profitability. In the fourth quarter, new investments in loans and securities were about $271 million, of which $47 million was opportunistic in the form of ABS bonds, and we received $170 million in return of capital from prior deals. In December, we also repurchased $7 million of our corporate notes at an approximate 12.5% discount to par, consistent with our stated objective of opportunistic capital deployment. Last week, we repurchased an additional $7 million of our corporate notes. Throughout 2025, discretionary investments in ABS structures, all in the form of rated notes, totaled approximately $171 million, representing about 27% of the total investments in loans and securities. Combined with cash, we now hold a healthy liquidity position under a wide range of scenarios. Our objective is no longer just liquidity. We are maturing and increasingly pursuing optionality. Optionality allows us to be conservative on credit, opportunistic on capital deployment, and patient on growth. In the fourth quarter, the fair value of the investment portfolio was adjusted down by approximately $50 million, and we added $97 million of new investments net of paydowns. Our guidance continues to reflect $100 to $150 million of rolling 12-month forward credit-related impairments. I want to remind everyone that this is not a forecast of losses. It's a governance on risk embedded in our guidance. It reflects uncertainty and remains consistent with prior guidance. Let me close with our 2026 outlook. We remain cautious in the near term given persistent macro and credit uncertainty. We expect volume growth throughout the year, driven by new application flow, new partners, and increased penetration of our products. FRLPC margin is expected to be between 4% and 5% for the year, and to revert lower within that range from current levels as a result of continued expansion in POS, contribution from new partners, and our funding mix. As just mentioned, guidance reflects the credit-related impairments, if any, of $100 to $150 million. Both first quarter and full year guidance reflect the full impact of last quarter's exit rate volume reduction of approximately $100 to $150 million per month. Illustratively, the midpoint of that range represents approximately $375 million of first quarter impact and $1.5 billion on a full year baseline, essentially assuming current uncertainty persists and leading to consumer and performance deterioration. If uncertainty recedes, we will adjust accordingly and swiftly. This is an important point, so let me explain. We are exiting the year with $10.8 billion of fourth quarter annualized volume, deliberately shrinking high risk volume by $1.5 billion on an annualized basis, while still delivering year-over-year volume growth. The reduction in certain credit tiers and new volume growth are not contradictory. They are two sides of the same optimization process. For the first quarter 2026, we expect network volume in the range of $2.5 to $2.7 billion, total revenue and other income in the range of $315 million to $335 million, and adjusted EBITDA in the range of $80 to $95 million. We expect GAAP net income for the quarter of $15 to $35 million. For the full year 2026, we are expecting network volume in the range of $11.25 to $13 billion, total revenue and other income in the range of $1.4 billion to $1.575 billion, and adjusted EBITDA in the range of $410 to $460 million. We expect GAAP net income for the year to range from $100 to $150 million. With that, let me turn it back to the operator for questions.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Our first question is from John Hecht with Jefferies. Please proceed.
Morning, guys, and thanks for taking my questions. Gal, maybe just go a layer deeper, in this concept of moving away from variable outcomes. Is it pricing in the market? Are you seeing something change with respect to payment trends, or is this, is it related to certain channel partners or certain types of products? Maybe just another layer of details on this.
Definitely, John. Appreciate the question. So before I'm going into the market dynamics, I want just to start with reiterating that message that we gave from Pagaya perspective has been the same for the last year. That we will always prioritize prudent risk management over short-term growth. And that principle that we have introduced, call it a year and a half back, is now fully embedded in the way we run the company. Now, the main reason for that is that we are a different type of animal, and we are not like many consumer finance platforms that rely on marketing spend to generate volume. We don't need to grow at any cost to justify our expense base. And this structural advantage is obviously giving us more flexibility to be disciplined, especially when we see early signs of different market softness. Now, when you think about that and the data we collect, it's really come to the core strengths of our platform, which is the ability to remove what we describe as tail risk or the variability outcomes, as you pointed out, in real time, through the fact that we see signals across 30 plus different lenders, 3 asset classes, that are a lot of data that allows us to be proactive rather than to be reactive. Now, the first point I would point out to your question is the market dynamics. So from a market perspective, there is just a lot of volatility. You don't need to look very hard to see that in the last period, mainly since Q4, the amount of volatility and declining rationality that we are seeing has just reached a new level. Financial markets are demonstrating much volatility driven by geopolitical, private credit. You see notable shifts in sentiment. And despite the fact that the consumer performance in our production remains strong and the ABS market are functioning well, it's definitely giving you a pause as a risk manager to ask the question of, like, what's your risk appetite and where you want to be? Now, as I mentioned, the consumer behavior data front, we don't see a specific deterioration, so nothing on the CNL or the CPR, and therefore our 2026 outlook of the impact of credit-related impairments, if any, is in line with our 2025 guide, which is the $100 to $150 million. We did see a clear shift in our partner behavior. Several partners have moved away from expansion to cautious as the year progressed. And the early signal is exactly what our operating model is designed to capture. If you will talk with our lenders, call it Q1, Q2 last year, everyone will tell you that, yeah, this is a year of going very strongly, aggressively growing 40-50%. When you spoke with the same folks by the end of the year, the posture and the understanding of the situation was much more balanced. And as we saw that, we decided to take even one step further and to be what we call ahead of the curve. Now, the way we operate and the way we do it very quickly and swiftly because of the technology agile advantage that we have and the fact that we can do these things real time. So literally a decision in the middle to late of Q4 can be related to all of that, and that's becoming our basis as we think about 2026. And EP will talk a little bit more about how we think about the guidance in that respect. I think before we close the question, I just want to emphasize that from an enterprise progression and execution perspective, what the team has done and is planning for 2026 is really exceptional. And we are becoming a better Pagaya, not just a bigger one. So think about it that only in Q4, we added forward flow in 2 new asset classes. We included a revolver capacity in personal loan and onboarded 2 more partners. So when I think about it from a CEO perspective, and frankly, I think you should think about it too, is that I'm very pleased with the team outcome despite the short-term reduction in risk decision that is trying very hard to avoid with any potential of downside because of a tail risk. And when I'm looking ahead on 2026, we remain very focused about executing on the things we can influence in our long-term strategy, which is expanding our partner network, deepening our existing relationships, and proactively cutting off tail risk rather than chasing short-term volume. So to end that part, I just want to leave you with 2 small nits. That the first one, that the fact that we have been more conservative is obviously retain our ability to scale quickly, which is why our guide range is intentionally wide. And the second is that even in what we describe a volatile environment that we don't want to be over risk on, we expect to deliver a meaningful GAAP net income profitability of over $100 million in 2026. So in other words, our entire 2026 guidance range, especially assume current uncertainty persists and lead to consumer and performance deterioration that we are kind of like taking as part of our plan. So if uncertainty recedes, we will definitely adjust accordingly and swiftly.
Yeah, maybe I'll jump in. So as we noted, right, this action translates to somewhere between $100 and $150 million volume cut in the fourth quarter. So effectively, that's a $1.5 billion of volume into 2026. And remember, we're more than offsetting that with volume from new partners and new products. So effectively, what we're doing is we're replacing higher credit risk volume with volume from new products and new partners that come in as a much more balanced risk. And if you think about, I'm sure you're wondering, like, okay, to jump ahead, what's next for 2026? What does that mean for the guidance? What needs to happen for that to change? I would say is, we are assuming this decision does not reverse for purpose of our guidance in 2026. And if we are right, we will not be chasing our tail for the year. And if we're wrong, we will reverse. And in that case, we would have left some money on the table for a few quarters. So something has to really dramatically change really in 2026 to go below the guidance that we have provided. The other thing I want to point out, though, and to close the question is, just think about in the long term, there is no real impact in the long-term part of the business. We're still looking at the 15-20% growth of this business, especially if you start thinking about the annualization of the new volume that comes in 2027 into 2028. And the last thing is obviously to keep in mind and let that sink in is this is still a business that's generating $100 million plus of GAAP net income even in that scenario.
Okay. And then follow-up question, which I think is somewhat similar to the last question in terms of where your focus is. It seems like there is more commentary about being focused on volume outside of decline monetization. Maybe talk about what products might have like increased momentum there And do the economics of those transactions differ from the decline monetization?
Sure, John, I'll take it. This is Sanjeev. Absolutely. I think you got it. You hit the nail on its head with your question. So essentially what we're doing is we are diversifying our products into the direct marketing engine that we've talked about before. We talked about the affiliate optimizer engine before, and of course, dual or concurrent look in auto, where we look at loans at the same time that our partners do, essentially first look. The dynamics of the direct marketing engine, where we essentially help our partners grow their originations, is very, very strong and very positive. And the performance is also substantially better. Same with the affiliate optimizer engine. We've essentially a business that has about a third of its dependency on Credit Karma and Experian continues to grow very, very strongly. Similar to what credit card businesses do, we are doing the same thing in personal loans, and we are substantially improving our partner presence with our existing partners in both of those platforms. And so that is something that has done extremely well for us. This is where the shift in the business is happening, and this is exactly where we are emphasizing that because of the performance of these products, that the economics in these are substantially better than what we have traditionally provided, because of better risk performance and better ability to charge better economics. So that's something that we definitely want to talk about. We have, as you know, 31 existing partners. Our top 5 partners are already on these new products. We have signed agreements on our pre-screen product, which is our direct marketing product, as well as agreements on Credit Karma and the affiliate channels. And we are starting to increase our dual look performance very substantially. I do want to emphasize one other thing that is extremely important, which is that we have also onboarded a record number of new partners. Gal talked about 2 that are onboarding right now. There's a third that's in process. And I fully expect that by the end of the second quarter, we will have onboarded maybe 7, potentially 8 new partners, which will be like a record for Pagaya. So what EP, Gal, and I are trying to do is emphasize is that we are focusing more on the shift in the business with our existing 31 lenders to more profitable partners. We're also focusing substantially more on getting new partners, essentially demonstrating that we are becoming part of the financial ecosystem in U.S. consumer lending, and we are managing the risk in a very thoughtful, responsible way as we grow the franchise in the long term.
Great. Thank you very much.
Our next question is from Kyle Joseph with Stephens. Please proceed.
Hey, good morning, guys. Thanks for taking my questions. Been a lot of headlines on private credit and the alts recently. Just wanted to get, you guys gave an update on the funding side of business, but how you're thinking about funding into your 26 outlook, given all the headlines we've seen in that world recently. Thanks.
Yeah, thanks, Kyle. Thanks for the question. I'll take it. I mean, look, the demand for our product and production is very robust. Look at Q4, a couple of the things that we announced, new deal with 26 North, which combined with the post deals generates more than $3 billion of capacity across these 2 products from the revolver structure of these. The sale of the certificate in auto, new forward flows in auto and POS, the sale of the certificate that we said on OWS. So generally very strong demand and validated by the execution that we're delivering for our investors. What I would say is, if you step back, 2025 was a year where you had a very frothy sort of private credit market deploying capital. And now it's becoming a little bit more normal and much more disciplined, and we're actually benefiting from that. I would take it a step further and say that some of the actions that we took is actually fueling more demand for our product and production. You look at the last ABS deal that we did a few days ago, we went to market with $600 million of size, and it got upsized by 30%, and still oversubscribed. So I think what you see is the platforms that have a very robust and very diversified set of investors that they work with, like Pagaya. We're benefiting from all of these. We'll continue to obviously continue to try and diversify our funding further. And all of that is on our pipeline. So I think we feel very good about the funding environment relative to our positioning in the marketplace.
And maybe one thing to add is that a lot of the, call it the noise around, which obviously impacting the full funding world, but like it's much more around the corporate side of the world, and specifically around SaaS, etc., and companies that have been in the sphere of trying to grab market share there. I think on the consumer side, which is a byproduct of that, but like you don't see that level of volatility or kind of like changes in the last quarter, but it is calling for everything to be much more realistic.
Great, thank you. And then just a quick follow-up, a modeling question for you. On the impairment side of things, given the underwriting changes you guys have made, what sort of level should we expect, to get to your GAAP EPS guidance for 26? Thanks.
Yeah, thanks. No change on that. We're still guiding to the, call it, under scenario A in our guidance of 100 to 150 million range for the year. Same as it was in 2025. So no changes there given the ongoing credit performance.
Great. Thanks for taking my questions.
Our next question is from Hal Goetsch with B. Riley Securities. Please proceed.
Hey, thank you. I just got a question. It's a bit counterintuitive given the macro trends we've seen over the year with falling inflation, rates coming down, job market generally good. And I think EP mentioned, hey, your action in the last quarter was based on increased uncertainty, not an increase in credit losses. So just wanted to, if you give us any more qualitative or quantitative color on what you saw your partners doing in your response. It just seems a little counterintuitive. It seems like things are going in the consumer's direction to be better credits, and this is just needs a little more fleshing out. Thanks.
Hal, hi. I think it's a great observation. In fact, those were some of the countervailing forces that we had in our mind as well at the end of Q4. On one hand, the macro was, what it was in terms of inflation and rates coming down, as you pointed out. On the other hand, what we were observing very specifically from our 31 lending partner platform was some of the partners that had been talking about credit expansion in the middle of the year were feeling less certain about credit expansion by the third, fourth quarter. So the sheer uncertainty in the market. And by that, as Gal outlined in his opening comments, there was clearly, geopolitical uncertainty, which was causing some uncertainty in the financial markets. There was some stuff going on at the tail end of certain businesses, certain markets. And so we felt that the most responsible thing for us to do, and that's the beauty of being a B2B2C market, is that in some ways we are shielded from the C, because the B that's between the C and us responds or gives us signals that based on which we were able to take actions at what we thought would be the most marginal risk tier in the business. And it is this theme of uncertainty in the potential uncertainty in the credit markets that drives us to think that we should be responsible and prudent rather than aggressive. But having said that, our ability to scale and be nimble is extremely high. So if things change in the market, which could change, rates could change, the market could change by the second half of the year, well, all we need to do is basically prudently turn that back on. And that is the reason why our guidance range is wide. But having said that, we as a management team have a very, very high conviction that we will deliver profitable volumes, which is why our GAAP net income number is what it is. Scott, you want to add anything to it?
No, I think one point to think in mind, like when you see losses, it's a little bit too late. And when you are taking it proactive before, that's the way to be disciplined. So like, you don't need always to look on the deterioration of your outcomes on the CNLs to say, now I need to take action. And I think, again, it's given where we stand and what we see, it's enough to actually say, you know what, I'm going to be more conservative on that part of the spectrum, and that's it.
Okay. And unlike maybe 2023, when you're still building the platform relationships with the lending partners, your pullback in some of those riskier tiers, that your lending partners were okay with that as well. There wasn't a relationship issue, because I think it was key in 2023, 2024 to build the platform, build those relationships. And in this case, it was this kind of pullback is okay with the partner.
So A, it's a good question. B, it's exactly what we told you, that in 2022 it's a different situation.
Yeah. Okay.
And C, the answer is no. They appreciate that. From them, 15% growth in the midpoint and a stronger Pagaya is much better than a 25% growth. But then in 3 months, 6 months, 9 months, we take it down on them. So stability is key.
Excellent. Yeah.
More than the actual growth number.
Yeah, that makes sense. Thank you.
Our next question is from Rayna Kumar with Oppenheimer & Company. Please proceed.
Good morning. Thanks for taking my question. Could you just talk about where you actually started to pull back? Like, was it a particular asset class, or was the action taken across the board?
Hi, Reina. It's primarily across the entire portfolio, with a little bit more focus on the personal and auto side, just because of the secular growth that we see in POS. And that was obviously on the later part of the quarter, and effectively that's why you see that sort of as an exit rate change into 2026.
Understood. That's helpful. And then just on your target 4 to 5% FRLPC margin for 26, obviously it's a very wide range that you highlighted earlier. Can you just talk about how much conservatism is baked in at the low end, and what are the puts and takes to get from the bottom to the top? And then if I can just sneak in one modeling question, if you can just tell us your assumption for 26 GAAP tax rate. Thank you.
Yeah, so as we have said before, as it relates to the FRLPC rate, appreciate obviously that is a wide range, and we'll look to narrow that down going forward at some point. But ultimately, the way to think about it, focus on FRLPC in dollar terms. So the more volume you get from your partners and newer products that come in at a low rate, you may see a sort of dilutive impact on the actual rate, but still coming in at higher volumes and therefore higher dollars at the top line. And then vice versa, if there is potentially, let's call it a slow ramp, when you think about the mix of the portfolio, if you see a slow ramp on the new product, new partners, you may end up with, call it a low range of the rate of the guidance on volume, but obviously achieving a relatively higher FRLPC. That's a little bit how to think about that across the board. So it shouldn't materially change sort of the key dollar amounts. On the tax rate question, generally speaking, I would point to call it a 20% type of tax rate. But obviously there's a lot of moving parts there, because obviously the business is coming out from a period where it was 2 years ago losing money, now into getting to cabineting and profitability. But that's what I would assume for going forward.
Thanks for the color.
Our next question is from David Scharf with Citizens Capital Markets. Please proceed.
Hi, good morning. Thanks for taking my questions. Maybe just to sort of dive in a little more to Hal's question and perhaps what your kind of behavior you're seeing from lending partners. That this was, so far an earnings season where a lot of lenders, pretty much said things are stable. There are certainly no rush to widen their credit boxes, but there certainly weren't indications that things were tightening either. Just so we understand, did you start to see by the end of the quarter, more evidence of turndowns, of loan application rejections by your partners that may have been approved by your partners 6 months earlier? Is that how we should sort of interpret the behavioral changes you're seeing?
I think the best way to look on it is many more expansions that were in play or in plan became not in play. So it's not to say that people are not saying, hey, we are going to continue to grow, but it has been shifted much more towards how do we do more asset classes? How do we get more to our customers rather than, the pricing are high and we're just going to make it more aggressive, or the losses are too low and therefore we're going to approve more type of population. So you definitely see a difference. And by the way, I think you will see on the growth numbers of all of the reporting companies we talked about that the growth going forward from a top-line growth is not what it used to be last year, especially on the personal loan and other side of the business.
Got it. No, that's helpful. I mean, obviously, as you noted, your business is in a unique position to kind of see the activities of multiple lenders as opposed to just observing your own portfolio. So that's helpful. And then just as a follow-up, should we think about maybe the recalibration on credit extending in reducing tail risk? Does that extend to how you approach your discretionary investing in securities in addition to originations or loan approvals?
Hi, Dave. This is CP. No, I think these are two different aspects, right? Two sides of the network. One doesn't necessarily tie to the other.
Got it. Understood. Thank you.
We have reached the end of our question and answer session. I would like to turn the conference back over to Gal for closing remarks.
So I want to thank everyone for joining us today. As you can tell, our results demonstrate the power of the B2B2C model we have worked so hard to build at Pagaya. Increasingly diversified growth with an unrelenting focus on disciplined underwriting, along with a growing list of partners and funding mechanisms that keeps evolving and improving. I look forward for 2026 and to share our journey with you as we grow Pagaya into a key partners for all U.S. consumer lending institutions, continually optimizing our product suite and value proposition to maximize the value we provide to our partners. We remain laser focused on the long-term potential of Pagaya as we penetrate this enormous market opportunity, a market that we created and that we lead. Thank you very much for your time today.
Thank you. This will conclude today's conference. You may disconnect.
Cool. All right. Took long enough.
Yeah. No.
Yeah. And just so people know, Nick had to go to. He actually has a day job. I don't know why he's employed. So he had to hop off. But yeah, I think we got some good insight. I'm honestly surprised when we were messaging the private chat that they didn't mention anything about interest rates.
Mhm.
You know, Pagaya themselves didn't mention anything, and then the analysts didn't even ask about if their guide and expects 2 interest rate cuts or 4 or 0. But I don't know what your thoughts were, but I think I'll go ahead and start just with a little bit of what I heard. I think, people were asking in the chat, why is revenue down? Why is guide down? And you kind of hear in the call that they're just being cautious, guys. Like they're trying to grow with intent rather than grow at all costs. And you hear them say that multiple times. And so they're trying to continue to grow profitably without having to worry about their higher risk loans. And so I think he was pretty much directly asked, like, hey, with all of macro being perfect, why are you guys still guiding slower? And he literally said they cut their much higher risk loans with newer products to their lower risk loans. And so that's why you see that growth slow down. And I'm okay with that as an investor. I prefer what you would call sandbagging and guiding for just sustained profitability rather than growing at all costs. The thing I heard that was awesome was they said 7 to 8 new partners by the end of Q2, which is insane. I mean, that's crazy growth. I think it's like what? That would be going from 34 to 42 partners in the span of 5 months.
Yeah.
At this point, so that was awesome to hear. But yeah, I mean, most of the commentary was kind of expected, just essentially pretty cautionary, kind of talking about how they want to reduce risk, and kind of questions around that. So nothing really was like surprising. But I don't know what your thoughts were, Trevor.
No, very similar. It's kind of like you said, you would rather them be more like they mentioned this probably 8 or 9 times, how they're trying to be more proactive than reactive, right? If they're already
Yeah.
seeing losses and then they make that switch to like focusing on lower risk loans, and they're already behind the ball.
Yep.
So I don't hate it. I understand as a shareholder as to why they're doing that, and I would prefer that. I would rather them. I think the one of the biggest one of my biggest takeaways from the call was their focus on the long term. They are focused on the long term thesis of their business, of their platform. Something that Gal said, this was his quote: "We are building a B2B2C platform that will be a cornerstone of the US financial ecosystem that should be embedded within every US consumer and lender." Like
Yep.
that is the long-term play with Pagaya. Like I truly think that with their technology and their platform, their scale, and how much they truly provide value towards their partners, something that's very important for Pagaya's business is that their values and their ambitions and goals are aligned with their partners. So the better their partners do, the better Pagaya does. And the partners like that as well. And then the better they do with more partners, the more credibility that they get, within the industry. And then it's just a snowball from there, right? Like they said, they onboarded what I think four partners in the last 12 months. It might be a little
Yep.
bit more than that actually. Because they
I
did
think
what? They did 3 in this quarter?
Yeah, they threw this. I think it's more than 4. I don't know the
Yeah,
exact number,
I
but
think
it's
I
good.
think it's 7 because I think they did 1 in the quarter that got cut out. So I think they did 7 and they guided for 7 to 8 in the next 2 quarters. Like
Yep.
that's a double up in half the time. Like that's insane. That's credibility. That's showing, our product works, and more lenders and institutions are realizing that, and they're
Yep.
realizing how much value their technology and their platform provides. So yeah, I think I'm on the similar wavelength as you as to where they're de-risking their business in times of uncertainty, and it's going to slow down growth a little bit, but at the same time they guided for I think 10 to 20% revenue growth, which they also mentioned. See if I can find the quote here.
And while you find it, guys, the guy's down to 13.70 a share, down 26%. To me, this is a crazy overreaction.
Yeah.
Like I understand the point. We're in a pretty bearish sentiment right now, and so I think regardless of the earnings call, honestly, it would have been down at least 10%. But anytime you see any sort of guide slowdown, it's always just a massive overreaction. Oh, this company's going to zero. They're growing slow. But you heard the entire earnings call, even with their guide, whatever the range was, I think it was 1.3 to 1.45 or 1.35 to 1.5, something like that for revenue. They still are saying they will still guarantee the 100 million in net income, and so you can tell their tone is focused on profitability.
Yeah.
And in the chat, Wealthmatica put that at $14 a share, Pagaya trades at a 0.8 forward peg ratio, which is insane. As the market opens, we can see it trade around that $13 or $14 a share.
Yeah, I mean,
Yeah,
even if you look
that's
at it
where we're at.
on a PE ratio in terms of they did what 80 cents in EPS.
Yep.
If you do annualize, that's $3.20. The stock's $14. That's like a P ratio of 4.
Yeah.
That's implying that the business is just done. Like there's no
Right.
growth. And then you hear what they say about the long term and where they're focused, how many new partners they're onboarding. They're still they basically, I can't find the exact quote here, but essentially what they said is, something really dramatic has to happen in order
Yes.
for them to not, or in order for them to go below the guidance that they
I
provided.
heard
So
that too.
essentially, like,
Yeah.
unless there's like a major recession, they're going to beat guidance. So if
Yep.
we have a normal macro for the year, then we should come in with 4 beats throughout
100%.
2026, or I guess, yeah, 4 beats.
Yeah. 100%. I heard that too, and I was like, basically, they're telling you without telling you, guys, we're sandbagging the hell of our earnings.
Yeah, pretty much.
Pay attention.
Yeah.
And so I think you're right. Like as long as we don't see some sort of insane recession, they're 100% going to beat their guidance.
Mm-hmm.
So overall, I think I'm okay with as an investor. Obviously, we all know it sucks to be down on a position 25% a day, but this is an opportunity, right? At least in my eyes. And so I like red days. It's less. I'm more anxiety induced when a stock's up 25% a day. Um, off of something silly. So I'm okay with a day like today. Obviously, we'd prefer to be up. But I appreciate everyone watching. I mean, we had like 50 people watching live on YouTube. We have like 2,000 on X, which I don't know if that may be bots. I don't know, but I appreciate everyone supporting and watching. I mean, there's not really much other commentary I have for the earnings and the call. Trevor, I don't know if you have anything else you want to add before we hop off here.
No, I don't really have much. I just think, my thesis remains intact. I think
Oh yeah.
in the short term, obviously, we're going to get a little bit of slowdown in growth. But at the end of the day, like I would rather, like I've said this before, I would rather management be more proactive and take less risk when there's times of uncertainty. Because if we do have that recession, they're still going to hold up a lot better than other companies that are continuing
100%.
to take risk. So, it sucks. I mean, the stock price is down. I already bought like 40 shares as I was listening to the call. I bought it at like $14. I was like, this is,
Well, I'm gonna join you. I'm gonna buy some right now too.
yeah, this is, I'm loving it. I still need to look a little bit deeper into the numbers, but I mean, fundamentally speaking, numbers look great. They've reached an inflection point in the business. Management seems very focused on long-term profitable growth rather than, focusing on short-term numbers, which is obviously as a long-term investor, that's exactly what you want to hear.
Yeah, $1 billion%. I think again, guys, like you'd rather the company to be straightforward with you and honest rather than they would be irresponsible and come in and go, oh, we didn't forecast this and now we're going to really miss guidance and it's a surprise. You want them to come in with a bearish sandbag sentiment and come in and crush it rather than come in and go, oh, we're going to crush this year. And they come in and go, oh, actually, there was some macro uncertainty we didn't think about.
Yeah.
You want the management team that's going to be thinking and forecasting the future and thinking about it that way. And so I'm okay as an investor investing in a team like this that's saving the profitability and growing sustainably rather than trying to force growth down your throat just to pump the numbers, essentially.
Mm-hmm.
And I love the quote that you brought that also, Nick and Wealthmatica put that, they're building the B2B to C platform that will be the cornerstone of the U.S. financial system. So they're thinking in, terms of decades, genuinely, and if you have a comment like that. And so, yeah, Ernie, you said they should have mentioned AI data centers. Honestly, I agree. They should have mentioned the AI data centers there. But yeah, I appreciate you guys watching. Appreciate the support. It's awesome doing this. And you guys will catch us on the next Pagaya earnings call. Talk to you guys later.
Good. Thank you, guys.